This article is hot off the press. You guys, if you have been following this channel for the last few months, we talk about we're very active on this channel during earnings season in the stock market, because during earnings season is when you're going to find out truly how these companies are doing. That's a very good reflection of the American economy, the American individual, consumers, families, small business owners, all the various little parts of industries that make it all work. And I find it to be very, very telling, because you find some really, really good nuggets of information, and we love to dissect those on this channel. And I'm warning you right now, if you remember a few months ago, actually Q3 and Q4 of last year, we were doing videos on here saying, watch out, earnings are not going to be great. They're going to try to adjust numbers. They're going to try to give you some early expectations. They're going to do whatever they can to try to dampen and soften the blow of what they're going to report. Well, just out this morning, it's not getting better, y'all. Macy's quietly lays an egg, and more may be coming for retail. Let me read this to you, because it's not just Macy's, okay? Here's another article from this morning, same author. Yahoo Finance trending tickers. Lululemon, Chico's, Macy's all issue warnings. So what I'm about to read you is basically happening across the board in retail. Macy's dumped some bad news on Friday evening. Management teams for public companies will sometimes think it's clever to try to bury bad news into a weekend in hopes investors will forget it before the opening bell on Monday. The lame tactic rarely works. So let's break down this textbook news dump Macy's pulled on a Friday afternoon. 1. Net sales expected to be at the low to midpoint of guidance for $8 billion range. Analysts were modeling for $8.3 billion in sales, according to Yahoo Finance. So next, number 2, adjusted earnings per share expected to be within the guidance range of $1.4 to $1.6. Yahoo Finance data shows analysts were banking on the high end of 1.6. Key management comments. Quote, based on current macroeconomic indicators and our proprietary credit card data, we believe the consumer will continue to be pressured in 2023, particularly in the first half, and have planned inventory mix and depth of initial buys accordingly, said Macy's CEO Jeff Gennett. We take a balanced approach to merchandise receipts and remain committed to offering fashion and value across nameplates and channels, with the capacity to adjust in-season buys and chase into areas of strength. With this earnings pre-announcement, Macy's essentially issued a profit warning for the first half of 2023, in addition to telegraphing a less than stellar holiday season. While Macy's inventory levels look to be in good shape despite the sales miss, look for this Wall Street to slash their profit estimates for 2023 amid margin pressures and more cautious consumers. I'll stop right there because it goes on, and you can keep reading this if you want to, but I will leave it right here. They do mention this is also Ralph Lauren, VF, Under Armour, and other suppliers, JCPenney, Kohl's, Dillard's, Target, the negative comments from Target last week, Walmart, Hasbro, Mattel. A lot of companies are having this same thing. They're trying to warn everyone very calmly and very gently, like, hey guys, look, it's just not going so well right now. Who was it that was saying they're gonna? Wasn't it Target that said don't return stuff? We'll just pay you to not return it. Target pays not to return. Wasn't that it? News. I'll get back to it. I can't find it at the moment, but it was one of those big retailers that was essentially saying, we have so much excess inventory from all the crap that everybody was trying to buy back during COVID when everybody got the free money. We bought so much crap to keep up with that. Now no one has any money. We have all this extra crap. And so they were saying, just don't return it. If you bought something and you want to return it, just keep it. Just keep it. It's less cost to them if you just keep it. So again, they're building on this. This will be now this will be 9 months consecutive, if not longer, but at least 3 quarters where the executives at retail outlets, like I just read to you, have all been saying, hey, look, things are not great right now. Building on that, building on that same attitude, here's David Sachs. David Sachs is a pretty smart guy. He was one of the founders of PayPal, along with a lot of those guys, Peter Thiel, Elon Musk, he was a part of that group. He's a very smart guy, one of the most successful investors in Silicon Valley. He had put this little tweet thread up just the other day that I was really liking. Now, here's what's crazy. This was back from November. Okay? And he retweeted this not so long ago saying, like, I think I was more accurate than I knew. He says here, Salesforce, the bellwether of software companies, saw net new ARR decrease by 2/3, and I'll go back to this in a moment, 2/3 in the most recent quarter. That's a huge slowdown, but also it implies the need to cut over $2 billion of sales and marketing if it wants to maintain CAC payback at reasonable levels. Okay, what the hell does that mean, Ryan? I'm not an expert in this crap. Just, boil it down. ARR from Investopedia. Accounting rate of return. The accounting rate of return is a formula that reflects the percentage rate of return expected on an investment. So the return that they expect. And here, Salesforce is saying that they're expecting a potential 2/3 decrease in the next quarter, their most recent quarter. So David says, this could become a vicious cycle. Layoffs, click that, there we go. Layoffs, then seat contraction, then sales slowdown, then cost cuts, then more layoffs, and repeat. He says here, to be clear, this is not a critique of Salesforce, which is one of the best managed software companies. It's a commentary on economic conditions. Yeah, and then again, this is actually why he retweeted the article. He says, update, as predicted, when sales slow, software companies must cut expenses or their unit economics will deteriorate. In turn, Salesforce's vendors will need to cut, and so on. This cycle still has a ways to go. New York Times actually just wrote about this. I don't know that I can actually open this. I don't subscribe. I think they have a paywall. Yeah, but, oh, gosh darn it. Can I at least get you... It says right there, Salesforce. I mean, the guy's like, he's got like ESPN or something, little Mean Girls throwback there. You can see the future here. It says here, Salesforce is laying off 10% of their company, or 8,000 jobs for that exact reason. So, watch closely. We'll keep doing more earnings episodes. I love doing earnings episodes. We're expecting all of the banks to report this Friday. Energy is in 2 weeks. We've got a lot of tech coming up in about a week and a half, so we're going to see a lot of various industries reporting how they are doing. You know that I will let you know. Take care.